The world is going to be full of people who are waiting to buy gold and who are broke because they didn't just bite the bullet and buy it. Just look at the price of gold in relation to the Dow Jones, because you have historical reference points where twice in the prior century at significant bear market lows, the Dow traded down to a single ounce of gold. In 1932, the Dow Jones was roughly equal to an ounce of gold. And in 1980, the Dow was roughly equal to an ounce of gold. So if you look at where the Dow is now, around 26,000, and figure, well, where would the price of gold have to be equal to the Dow? Well, at the current price, 26,000. But maybe if we get a big bear market, those two could meet around 15,000. And so you'd have the Dow Jones at 15,000, which is significantly below the current level, and you'd have gold much higher. But of course, if they create massive inflation to prevent that stock market bubble from deflating, it's possible that an ounce of gold and the Dow could meet at 50,000. It does, the key is that they're the same price at some point, not necessarily what that price is, but that they're the same. Everybody is getting bailed out and nobody is getting a bill. Nobody's taxes are being raised. Everything is being paid for by the Fed because we think it's all free, because everybody believes in MMT, whether they want to acknowledge it or not. But we're about to see that it's going to be a complete disaster, because the dollar is going to collapse. And then, of course, what the MMTers don't get is, well, what do you do? What happens when inflation goes out of control? What happens when prices really start to go up? How do you stop it? Once you've let that genie out of the bottle, how do you put it back in? It's impossible. I mean, we're broke. We're already hopelessly in debt. The middle class can't pay higher taxes. If they raise taxes on the rich, well, they won't collect very much. There won't be much wealth left after they finish taxing it. So the only source of the money is the Fed. So obviously they're going to embrace this theory because it's so self-serving. And, they've been lulled into a false sense of complacency because it seemed that we've been able to get away with it. We have printed all of this money since the '08 financial crisis, and everybody thinks it hasn't caused a problem. Everybody says, look, see, there's no inflation. We printed all this money. The balance sheet has exploded, and look, prices haven't gone up. So they now have this false sense of security that there's no limit to how much they can print. Well, what's basically been keeping us from having to deal with those consequences has been that reserve currency status, has been the willingness of the rest of the world to hold on to that paper in the form of treasury bonds or corporate bonds or mortgage-backed securities or even U.S. stocks, right? So as long as they're willing to park the money in financial assets, then it doesn't bid up consumer prices. But once they lose confidence in the dollar, then they lose confidence in all dollar-denominated assets, and now they want out. And now all that money is going to come rushing back to the U.S., bidding up the price of whatever's not nailed down. What we've seen so far, even with the civil unrest and the riots and the looting, this is just a small dress rehearsal for what's coming. Because when the dollar crashes, and prices skyrocket, right? These stimulus checks, or whatever welfare benefits the government wants to dispense, they're not going to be worth very much. I mean, because you're not going to be able to buy anything. And I think the government is going to respond to the surge in consumer prices with price controls, kind of the way we did in the 1970s. But prices are going to be rising much faster now than they did back then. But I think there's going to be controls on all sorts of consumer goods, and that means shortages. That means long lines. And I think there's going to be power rationing. And so I think you're going to see a real blow up, particularly in the cities. There's going to be a lot of crime, a lot of violence associated with widespread shortages and a lack of food and power outages. So things are going to get pretty bad as we go through a monetary crisis. It's not, this is not just a financial crisis. This is a U.S. dollar crisis and a sovereign debt crisis. That's a whole nother ballgame. Prices are going up, but that's not inflation. Because if the Fed didn't create all this inflation, maybe those prices would have really come down. Maybe consumers would have gotten the benefit of a lower cost of living. But the Fed stole that benefit away from them by creating inflation. But look, all of this inflation is going to come home to roost. All of a sudden, we're going to catch up and we're going to see dramatic increases in consumer prices. And then when you go back over the entire period, you can say, oh, look, prices are up 10% a year or whatever they're going to be, because all of a sudden they're going to shoot way up. And it's not going to matter that they were benign for a while when all of a sudden they skyrocket and catch up to where they should have been. But the cause was all the inflation the Federal Reserve has been creating the entire time. You go back and get a Webster dictionary from 100 years ago, and you read what inflation is, and it'll say inflation is an expansion of the money supply of money and credit. Rising prices are an effect of inflation. Money supply inflates. Inflate is to expand, right? You don't expand prices. What is being expanded is the supply of money. That's inflation. Inflation is an expansion of the money supply. Deflation is a contraction of the money supply. The effects of inflation and deflation are on prices. When you have inflation and you're inflating the money supply, prices will go up. And when you're deflating it, prices will go down. But sometimes you can inflate the money supply and prices don't go up because the inflation is preventing prices from going down. But don't confuse changes in prices with changes in money supply. Money supply is inflation. Prices are just prices. The central bankers want to pretend that inflation has to do with prices because they don't want to be blamed for it. When you accept the real definition of inflation, which is an expansion of the money supply, then you know who causes it. It's government, it's central banks that cause inflation. But governments want to blame inflation on the private sector. That's why they want to redefine it as prices. And you're playing into their propaganda by trying to perpetuate the idea that inflation is caused by greedy businessmen raising their prices. We've never seen inflation like this. Money supply is growing at the fastest rate in U.S. history. I think year over year, it's up about 25%. Look at the Fed's balance sheet. It's just skyrocketing. And of course, most of that increase in the money supply happened in the last 6 weeks, not in the last 52. And the amount of inflation that the Fed is going to be creating in the weeks and months ahead is actually going to be greater than the amounts that it's already created. This is never a good thing. You know, inflation is a tax, and it's the most vicious tax because it hits the most vulnerable. It hits the lower class, the working poor, people who have savings. It destroys the value of a lifetime of savings. It destroys the value of the wages and salaries that people earn. You know, we're paying for government through inflation. Literally right now, half of every dollar the government is spending has been borrowed, right? We're borrowing right now as much money as we're collecting in taxes. And soon we'll be borrowing more than we're paying in taxes. But since the Fed is monetizing most of that debt, the American public is going to pay for all that government through inflation rather than through taxation. And believe me, when you pay for government through inflation, it ends up costing a lot more than if you honestly paid for it with legitimate taxes. We're going to see inflation much higher than what we saw in the 70s. And of course, you know, the CPI is very different. The one that we have today doesn't measure prices the way it did back then. I mean, if we had a more honest CPI, it would already reveal a price increases that are much higher than what the government has been admitting to. But even based on the way they're measuring them now, we're still going to take out the levels that we saw in the 70s. The question is, will it go from very, very high inflation to hyperinflation? And the jury's still out on that. It is very possible that that's where we end up. But in order to avoid that fate, the Federal Reserve is going to have to do a lot of things that up until now it has resisted doing because of the terrible immediate consequences. What the Fed would have to do to avoid hyperinflation is allow interest rates to rise sharply, even though the economy is in a recession. And even though the stock market is tanking, the real estate market is tanking, banks are failing, companies are going bankrupt, and the government is not going to be able to pay its bills. The government won't be able to make interest payments on the national debt. It won't be able to pay Social Security or Medicare. And the Fed is going to have to sit back and allow all this to happen and refuse to bail anybody out because that's the only way to escape hyperinflation.